All right, ladies and gentlemen, final cut of 2023. Absolutely crazy that this year has gone by. And I should say, welcome back. Acquire and operate Micro SaaS. We are in the game of acquiring and operating Micro SaaS, as the title implies. This is your gracious host, Kale. I'm hanging with my co-MC, K. Lou, who's back, healthy, fit as a fiddle, and we're psyched to be hanging. So just to, I guess, set kind of the groundwork for today. So I think we're up to 20 now. We did a deal teardown last week looking at a seafood processing or SaaS catered for seafood supply chain and processing groups. Today, we're going to be diving into it's an operating concept. And again, it's a little bit of a departure from the typical programming where we're looking at the operating concept through the lens of an acquirer or an investor or a financial sponsor, however you want to think about that, as opposed to in the trenches operating a SaaS firm. So we're going to be digging into buyer profiles and Micro SaaS. And why is this relevant? Well, actually, we'll save that. I think next up, we're going to be doing an OKR teardown, which was basically we did our first substantive product roadmap release this quarter. And so we're basically taking that OKR and we turned it into a product release playbook. So expect that the first week of Jan, and then we'll wrap with some musings, which who knows? And then, a little sneak attack. With the quarterly wrap, you'll be getting a portfolio performance share out probably first or second week of January. So those are always heady, very thorough. And we'll be keeping it moving. So let's jump in. Well, I guess before we do, K-Lou, convention, right, this is alternative assets, right? Mm-hmm. And usually you've got private equity funds, venture capital firms or funds, and then strategics. And that's usually kind of the lay of the land. You're either private equity or VC, which is like, hey, we invest in early stage companies, sometimes pre-product, sometimes pre-revenue. They're going after huge markets and there's crazy upside. Maybe they're demonstrating traction or we have a lot of belief in the founding team. And then you move up kind of the scale of revenue or maturity or time, however you want to think about it. And then private equity starts to enter the equation, where there's kind of growth equity, which is a little less risky. Now we're post-revenue and they want to take the kind of proven the product. They want to go prove the market and take the market. That's where buyouts start to occur, which should be a familiar name for us. Or LBOs is the most conventional, right? Leveraged buyouts, because you use a lot of debt to make these acquisitions. Then you get into spin-outs, carve-outs, all that kind of stuff. And then, of course, in that same tranche, you have strategics, which are corporates and corporate development. And they're established businesses that are like, we could build this thing, we could partner with someone to do it, or we could buy it. And they go into the market and buy it. And the challenge is that all of those players usually, aside from venture, right, you have to have a crazy growth profile or you're going after a huge market. But beyond that, those other players don't really start to play below 5 million. So what's the problem with that, K-Lou, if we're trying to use those buyer profiles for our world?
So I would say the problem with not looking at firms that are less than 5 million is essentially there's a lot of opportunity and low-hanging fruit being left on the table there.
Totally. And I guess, or what's the problem for us, right? If somebody's like, which are you? You're like, well, shit, we don't fit into any of those categories. We play in micro, right? It's Micro SaaS for a reason. So I think this has kind of been one of the unanswered questions, which is like, who are the acquirers, the buyer profiles that are active in Micro SaaS? Because there's this whole universe, as we know, below 5 million. And the conventional world, it's still kind of emerging as, I guess, a derivative of the alternative asset class. And it hasn't gotten quite as much attention, I guess you could say, but to a degree where there are there's nothing, like if you Google buyer profiles in Micro SaaS, you're not going to find much. So
yeah, there's somewhat of an identity crisis once you get below the $5 million mark, because above 5 million, you know who you are. You're institutional. This is where you play. This is your sandbox.
Totally. And so for us, and I guess it's important, because if you don't know what you are, it's very hard to communicate it to people. Right. And I guess people in our case is usually investors. They're like, okay, or it's hard to communicate where you are. It's hard to communicate your vision and where you want to go. So we kind of lack a vocabulary, right?
I was going to say, how do you reverse engineer with from the start in mind or from the end in mind, right? If you don't even know who you are, or what you're trying to accomplish.
Totally. So I think that's obviously one side of the spectrum is you need to use a vocabulary that other investors in your audience speak to speak, so to speak. Yep. And then on the other side, when it comes time to exit, just like we have ideal customer profiles for our SaaS firms, ooh, this is who we're trying to, this is the perfect person that or user or account that's most likely to buy our thing. You need to have that profile in mind when you go to exit, when you go to kind of sell a business, right? It's like, ooh, this is the ideal buyer. Otherwise, you spend all your time spinning around talking to folks that aren't a fit for your SaaS based on the profiles that you know. So
And then how
that
do you truly
is,
validate performance? Because that performance is subjective based on who you would like to sell it to, right?
there you go. There, yeah, exactly. Or they're looking for different things. So you're going to obviously lean into different merits, right? All right. So we're going to look at the table view of this. I typed out the long form in the blog post just to spare everybody the fun of maybe stepping into a Notion table. But obviously, I would highly recommend you look at the table because it's way more coherent and easy to follow. But first things first. So we scraped all the marketplaces and we needed some base rates. And the first kind of thing, and I guess following, kind of convention is like, all right, there are probably swimming pools, so to speak, at different tranches of ARR. So just like you have a
Mm-hmm.
lot of financial sponsors, like the very, very bottom is usually 3 million. The next one that plays kind of down market is 5 million, and we're talking ARR. And then above that, you have a whole bunch of financial sponsors and the such and corporates playing at 10 million. And then you have a bunch playing at 50 million. Because traditionally, the more revenue, the more stable the business, and the tactics change. And usually what succeeds consolidates. So as you move up market, it's more of M&A strategies, inorganic growth, et cetera. So I kind of followed that as a mental model to think about how we would kind of initiate a thought process around buyer profiles. So for us, we scraped all the marketplaces, did some cluster analysis, turned them into quick histograms. And there were like, it wasn't like, oh my God, obviously that one, that one, that one. It was like, okay, there's a blip here, there's a blip here, there's a blip here. So I think it's worth noting that these buyer profiles aren't like in stone, and they're kind of a work in progress. They're a thesis, if you will. But we organize those tranches or those swimming pools around 500K in ARR or below, 500K to 1 million in ARR, and then 1 million plus. But I should say, in all honesty, it's kind of 1 million to 3 million is where, and I should update that because that's a more accurate representation. So we've got our sub 500K players, our 500 to 1 million players, and then our 1 million to what should be 3 million players. And we've gone ahead and we've kind of given them, and this is just like a persona ICP exercise for SaaS
Yep.
operators, right? So we've got our profile, we've got a description, and then we've got some key characteristics and quantifiable factors. So the first one is side hustlers. And that's exactly like it sounds, right? They're like, hey, and I'm an engineer. I've built some cool shit on the side in the past. Maybe and there's kind of that trajectory is kind of like a startup trajectory where they're like, ooh, I'm going to build a micro SaaS, a little mini app and try to commercialize it and get, 1, 2, 3K of income and kind of diversify my risk across my W-2 and my employer. And I can
Right.
moonlight and do this. Then there are those that are like, ooh, I don't know how to build something, but I can maintain it and I can enhance it over time. And I've got 100 grand saved up. I'm going to go buy a micro SaaS company. And so these folks have a day job. They want, and then I guess in terms of the nature of the business, what would you call out? Like, what are they looking for?
They're just looking for something that doesn't really require a ton of support because at the end of the day, they do have a day job and it's just supposed to be something that's very minimal on the side. Something that's already has a very buttoned up tech stack. It already has like some templated support responses if anyone reaches out, but it's really something that they really don't have to touch or do much with, maybe spend a couple hours a week and it just manages itself.
Totally well said. Brain dead product led onboarding. You sign up. Hey, I want a thing that, does this. Cool. Users buy it. They sign up. They enroll.
Yep.
They have no support tickets or they have issues, kind of once a month, something like that. And the business is generally stable and more important, kind of like the burden, the weight of the business is minimal. Because again, as we said, this is on the side. Cool. So then moving into first time acquirers. So the distinction here is that these are folks that are very likely coming from a tech, like an engineering background or a go-to-market background.
Mm-hmm.
And they're like, I want to do this. So
I'm
what's
tired of my
interesting
day
is,
job. Let me do something different.
what's interesting is that the thing that I guess is worth noting that isn't necessarily explicit here is that often they're reliant on the income of the business. So that kind of is a forcing function for the ARR threshold. So they need to be playing probably above 300K if we assume, a 50% profit margin. They need to be making 100 to 150K to sustain their lifestyle or whatever the case may be. But the side hustlers can go way down to like, 2-3 grand MRR businesses when they acquire them. We group them in the same tranche, but this could be like a sub 250K for side hustlers and then sub 500K for first time acquirers. And I think maybe that's an adjustment we should make too. But anywho, these folks, the distinction is they're going to do this full time. And they want a business where they're like, ooh, I know the domain because I've worked in it, or this thing needs go to market and I've got a track record and evidence that I'm pretty skilled that way. And again, they're going to index towards simplicity, right? And then I guess what else would you add in terms of growth rate or sources of capital? What does that stuff look like?
Yeah, I'm not really sure what else you would add to that right now.
Yeah, so I mean, I think growth rate, they want some kind of net positive growth, right? They don't want a business that's in decline because they're betting everything, right? So this is their
They
first
want minimal
kind of,
churn rates, things like that.
yeah, so they're looking for sticky products, healthy customer bases. Some other things to add that are a little bit outside of the actual business itself, more their dynamics are, they probably have less than 500K and it's coming from friends and family. So they're like, hey, I've got 150K across my mom, me, and my uncle. And it's probably going to take me 60 to 90 days to get the deal done. Maybe I'm using an SBA loan to do the deal. So that's going to draw out the acquisition process. And as we said, they want kind of net positive growth. It doesn't need to be juicy, but it's like, hey, this thing's growing 5, 6, 7, 8, 9, 10% year over year. And we've got, and I guess said another way as it relates to the customer base, there's no customer concentration risk. So there isn't one or two users or accounts that are generating 20, 30% of the revenue because yay, happy days, you bought your first business, you step in, oh shit, your elephant user churns, 20% of revenue just fell off a cliff. Now you can't, now you're eating peanut butter on the weekends. So that's that one. All right. So now we're going to step up into what I would say is, I guess, like a little bit a more professional tranche, if you will. So now we've got starting with kind of professional portfolio acquirers. And I guess we were the first time acquirers. And that was the narrative. Hey, this is kind of a proof of concept that we can create value in this asset class, that we can originate deals, we can value them, we can execute transactions. We have transformation plans, value creation plans, and then we can exit them. And then obviously we aspire to move into the professional portfolio acquired tranche, which is playing in the 500K to 1 million. And that tranche flexes up, honestly, beyond 1 million. But these are folks who are experienced in managing similar SaaS businesses. Their due diligence is going to be way more dialed. Like they've done this a few times. They're carrying a portfolio of, call it 5 to 10 companies. And obviously they want stability and recurring revenues and all that good stuff. But there's also a consideration on EBITDA margin, because all of a sudden, before it was like, hey, I need margin to live off of and to pay my team. Now it's like the EBITDA is the source of value creation ultimately, right? That's the machine is meant to generate profit at the end of the day. So they need to come into something where they have a good conviction around what EBITDA is doing, and then more importantly, what potential it has, which is a function of top line growth and margin improvement. So you can either grow revenues, or you can increase the efficiency of growing those revenues, which basically lowers your costs, right? So there's kind of two levers at the most macro level.
Question there,
so anyway,
before points for education for the audience. So let's say you come into one of these businesses and you're looking at the EBITDA, right? What is typically the first way you've seen folks look to increase that margin? Is it by standard just reducing expenses? Is it selling more widgets? Is it increasing the prices on the widgets? What happens in the industry?
Yeah. So figure those are the only two ways. So if we assume that our costs for the most part are fixed, right, and you grow revenue, that's going to go direct to margin. That goes directly to the bottom line. I would say what's more common, because you can't just grow, it's more quick. It's quicker to reduce costs than it is to grow revenue. So usually you come in and you just stack rank expenses on the P&L. So let's start with the biggest line item, which is usually talent. And it's like, all right, are there full-time employees? Do we need full-time employees? Can we pivot to a contractor, part-time freelancer model? Cool. Can we pivot towards a global labor market? Because obviously that has a huge impact on cost structure. So most of the levers are around talent. And then tech stack, you could go into hosting and cost of goods sold. So, are they, I mean, it's not likely that it's on-prem, but it's like, are they using some weird ass hosting thing and we can carve some points of margin off that way? Are they spending kind of superfluously, and you know this world better than anybody, on tech stack? Like, do they have a bunch of redundant tech stack? Because I'd say
Exactly.
it's like people, process, and technology are the three pillars of a business, as we know. So it's people and tech are usually the big usual suspects there.
I'm happy you said it because I wanted to use this opportunity as a shameless plug for everyone listening to get their RevOps muscle kind of built up a bit. No matter what business you walk into, when you're thinking about EBITDA, you're thinking about revenue operations and finding efficiencies there. So when you're looking at people, process, tech, do we have the right people? Are we running the right processes that aren't taking hours? When we look back at the RICE framework, what's the impact? What's the reach? What is the effort? What is the cost? And then when you look at the tech stack, do we even have the right tools that properly empower the people and enable those processes? So it's all about RevOps, and that's where you can find the best efficiency to reduce your EBITDA, then to increase your margins.
Totally. And I guess visibility into productivity is usually a function of tech stack too. So it's like start with analytics, and
Exactly.
it's like, whoa, our time to resolve a support ticket is way too long. Let's go after that. Like, support is not as lubed up as it could be.
Yep.
Um, so cool. So now moving on into serial acquirers. And I don't think we need to spend a ton of time on each of these line by line. I think the big tranche, like, kind of step function is you got like side hustlers into I'm doing this full time, into I want to do this with a portfolio at an interesting scale.
Mm-hmm.
What's another option that's kind of similar to the portfolio acquirers is serial acquirers. And these folks, I think the distinction is that they're doing one business at a time. So they're kind of flipping houses versus carrying a portfolio of houses they want to rent, right? So they come in, they've got like kind of acquire it in 30 days, transform it for a year, let it grow for a year, and then overlap that 1 year growth period with getting the next one going. And so they're less kind of doing it at a portfolio, I guess, level, and more so like, I want to just do these back to back as quickly and efficiently as I can. And so those definitely exist, and they're a little more kind of lone wolfy. Like with the portfolio acquirers, they establish kind of teams and shared services where it's like, hey, we have a growth marketer that works across 4 companies. We have engineers that work across 2 companies, but no more than that, or et cetera, dedicated to each firm. Whereas serial acquirers get in, fix it, grow it, sell it. Then you have niche specialists, and this is basically like, and you'll see a lot of this just to tie it back to the concept we touched on last week in terms of like themes or flavors of buyout investment thesis is that they're like, hey, I know the shit out of developer productivity tools, or I know the shit out of data analytics or something like that. And so they're just literally keeping an eye on that universe of businesses, and then they're very active, and they acquire function or tools, technology, and a lot of times they're rolling that stuff up, but they're just all about a dedicated niche. And I would say vertical B2B SaaS is like saying North America, right? It's like, oh, okay. Whereas vertical, like, niche players are like Denver, Colorado, Rocky Mountains, and it's like, oh boy, so they're actually niche. So anyway, on to technology integrators. So this is similar to niche specialists, but with technology integrators, they're like, hey, our tooling or our portfolio of products, right, which aren't necessarily attached to different companies, does this. We need to acquire, or we need to build, partner, buy this very specific technology. And then so that's what they go out into the market to buy. So they're like, we want to buy, like, our stuff is built on React, or it's whatever. We have a code or a tech stack product wise that is this. We're kind of missing some automation, or obviously generative AI is a huge thing now. So they'll
Yep.
go out and they'll acquire something specifically for the technology and the IP that they're after. And sometimes these are acqui-hires too, where they'll just go grab the team that's specialized in that technology. Anything to add there, Kev?
Yeah, no, I was gonna say, with generative AI now, that's where you see a lot of people kind of seeming like they're falling into this technology integrators bucket. So everyone who has a solution, they're going out and now trying to acquire or build another solution that includes generative AI to layer on top of their current solution, where it just spits out more insights for you, the users, and everyone else, when in fact it's really just streamlining the user engagement process, the user support process, which is brilliant, but it's not truly a technology integration.
Yeah, totally. And most of this is interoperability. So, or you can think kind of, it's a big motivator for M&A too, where it's like, hey, our thing does CRM stuff. We want to add some finance and invoicing. Cool. Let's go acquire a company that does that and merge them together.
Right.
That's a good distinction. Then you have regional expanders, which is interesting. I think this is way more, I guess, prevalent in like conventional entrepreneurship through acquisition or search funds, where they're like, we own, this carpet cleaning thing in downtown Denver, and we're going to go buy all the ones that serve the suburbs and consolidate carpet cleaning in the Denver metropolitan area. Or another thing can be, we own a CRM, decent market share for SMB in North America. We're having a hell of a time expanding into Asia. There's language barriers, et cetera. We're going to go acquire a player there, and that's how we're going to generate expansion. And those groups, I mean, the thing is that they're always very, I guess, thoughtful about revenue contribution. So they're like, hey, we want to, because at some stages we noted, right, like the only way to grow is through inorganic acquisition. So it's like, all right, we need to grow revenue 20% next year. We feel like we've, drank the well dry in North America. The only possible way that we can yield this kind of revenue growth is to go acquire something in a different market.
Yep.
So you'll see that as a motivator. And then strategic expansionists. So now we're starting to get into, like, we could say corporates or strategics generally, but this is usually smaller groups. And they're being very thoughtful about market share or technology. Like, they're kind of a blend of technology and regional expansionists. Like they're just strategic in that sense, but they don't stick to one flavor. So they're like, we're going to buy this company because it improves our technology suite. We're going to buy this other company because it's going to expand our revenues or diversify our revenues out of North America and make us more global. There's some motivations there, but that's kind of a hybrid of the two before. All right. That's the 500K to 1 million. We missing any?
Nope. Time for the big boys.
All right. Let's bring it home. 1 milli to 3 milli. So now we get into corporate integrators, which is really just like corporate, I guess M&A, so corporate development. So, and then we have kind of small financial sponsors. So this is where you start to run into actual private equity firms that have full-time staff, they're GPs, they have LPs, et cetera. And they're like, we have a thesis. We're going to go acquire companies that fit this thesis, or we own this company. We know that these companies would create synergies. We can merge customer bases. There's domain expertise over there that we could use. There's technical synergies that could be had. Cost synergies, Jesus, that's the first one, where it's like, hey, we're going to go acquire this business, and then any kind of administrative function, we're going to consolidate into one entity. So we'll probably strip out all the costs of the first one. This is the stuff that kind of gives private equity a bad name. But anyway, that's what they're looking at. And they're usually investing 3 to 10 million. So think if the business is doing $1 million and the multiple is 3x, the starting point for acquisitions here is 3 million. And they're way more ROI focused, right? Whereas before it was like, hey, we want to expand revenues. We want to diversify customer bases. This group is like, we want to see like some kind of return on capital that is above a hurdle rate, which is usually in private equity, like 20 to 30%. And they have much longer timelines. They're thinking 5 to 7 years. All right, into industry consolidators. This is kind of like regional expanders, technology integrators, only just at a bigger scale. And again, this is way more cost driven. So they're like, we're going to buy these companies because it's going to make the Voltron company more efficient, right? Because ideally the fixed costs are what they are, and we can consolidate the fixed costs. Maybe there's some marginal gains on the variable costs, but this is like, we're going to acquire this company. We'll grow revenues a little bit. We're going to, acquire market share. We're going to reduce overall costs across the two entities by like at least 20%. And we know that post acquisition, we've got good data on it that our market share is going to, increase cumulatively by 15%, something like that. But they're trying to consolidate an entire industry. And you see this a lot with business services, professional services, productized services to a degree. But that's that. And then we have strategic diversifiers, which is kind of the inverse of like intentional growth, right? I guess if we're thinking like you have kind of reward and risk, there are some groups that are anchoring their strategy around reward, which is regional expansion, new customers, new revenue. Other groups kind of see those same tactics through a different lens, which is like, oh shit, we're completely reliant on this industry. And if this industry starts to face some headwinds, or market conditions, put it into a down cycle, we need to diversify our risk. So the intent there is like we have a portfolio of companies that represent a portfolio of products. We know that we're overexposed to this thing. So we're going to buy this other thing over here to reallocate that risk exposure and give us a little bit more of like a kind of a cohesive risk profile that we're after. So they are very trend driven. They think about things
Yeah.
through risk versus rewards. Yeah, I'd leave it at that. Anything to add to that one?
Yeah, I was gonna say they have to be very trend driven. Like whereas a lot of money is going into market research, because at any point in time you have to understand how policies being driven down by the government, or just maybe if you're targeting a younger group of customers, let's say between the 15-year-old or 16-year-old to like 35 age range, their interest might shift fast. So a lot of these various factors that might be unbeknownst to you, where that's why you're spending a lot of the money to do the market research to understand what are the factors that are influencing these trends. You're basically just a trend analyzer day in, day out. And the moment you start to see a shift, it's okay. Now all of your business decisions are now shifting at the same time just to survive.
Yeah, or it's like, hey,
tough.
we noticed this thing's happening. Shit, if it continues to happen, we're going to take a hit here. How do we reallocate our resources to kind of reduce the risk that could be catastrophic? And
like
as
the
you
banks
mentioned,
with the bond
regulatory
market this
change,
entire year.
totally. Regulatory change, interest rates, all that stuff has a huge implication.
Oh, yeah.
Yeah, I mean, that could be, in LATAM, right, with all the currency risk, it's like we're totally nervous that we're anchored around a place where the consumer, their spending power is super volatile. So that could lead to churn, that could kill our business. So we want to diversify into more stable economies. There's a lot.
And
of
then you're looking at what BRICS is doing with cutting out the U.S. dollar as the intermediary exchange. There's a lot of things as it relates to just currency in the last few years since the pandemic. It's exposed a lot of just how many gaps we have in our foundation and how policy influences all of that.
Totally. All right. Well, holy smokes. All right. So just to kind of summarize, we've made it through the profiles. You've got the side hustlers playing at sub 250K. They're just trying to get something going. You've got the first time acquirers playing at 500K. They're moving into this full time. They want to do it professionally. And then most of them are going to scale into professional portfolio acquirers, which is now in kind of that 500K to $1 million, or serial acquirers. In the same breath, you've got niche specialists, or the same tranche, niche specialists, technology integrators, regional expanders, strategic expansionists. And then we start to play in the north of 1 million, where we start to see kind of the traditional players, actual private equity funds, corporates that are making, kind of, or strategics as they're referred to, that are making very intentional acquisitions to either bolster their position revenue-wise, customer-wise, increase the diversity of their portfolio to reduce risk, increase change the exposure geographically, or by a million other metrics to kind of diversify their risk. So that's that, my friend. I think we can go ahead and wrap there. And I think with that, man, I guess this is a little off the cuff, but just want to thank everybody for riding along. I mean, I think the growth in for the love of the game and the people that are tuning in and the feedback that we've gotten, I think building in public was a very intentional decision. And so I'm just super grateful for the people that are riding along, for those that have been touched by the content, for those who have been, I guess, nudged along in their, acquire and operate trajectory, or, I guess if this persuaded you to take that path and kind of define your own world, that's what we're out here doing it for. So I much love, man, from the bottom of our hearts. And we're thrilled to pick it up in 2024. So with that, for the love of the game, 2023, that's a wrap. K-Lou, pleasure to run with you, my friend.
Pleasure to run with you too.
Yeah, peace, buddy. Have a good rest of the day.
Take care.
Cheers.